Fortune just released a study on the housing market, and they concluded that the housing market might be in for a shock because we could see a whole lot more homes hit the market for sale, which could flip the housing market that we're seeing right now. What's up, everybody? I'm Jaspreet Singh from the MinorityMindset.com, where money minds rethink rich. We have been seeing a perfect storm in the housing market. We have super low mortgage rates. We have a very small inventory of homes available for sale, and at the same time, we had a massive demand for people wanting to buy a home. We've been seeing super low mortgage rates because after the 2020 pandemic, the Federal Reserve Bank came out and they wanted to encourage spending and they wanted to encourage people to borrow money. So they went out and they cut mortgage rates to the lowest mortgage rates and interest rates that we have ever seen in history in the United States, which made it much cheaper for people to go out and borrow money and go out and buy a home. We had a low supply of homes available for sale thanks to the help of government programs like the Mortgage Forbearance Program, which said that if you have a government-backed mortgage, well, then you could just take some time off of your mortgage and you don't have to pay. So a lot of people who considered selling their homes didn't have to because now they didn't have to pay their mortgages. And if you didn't have the means to pay your mortgage, well, you didn't have to worry about going into foreclosure because the government also blocked foreclosure. So you didn't have homes going into foreclosure. You had a lot of people not selling their homes because they're in forbearance. And so now the only people selling their homes were people that didn't fall into these categories. So you had a very small inventory of homes available for sale while you had very low mortgage rates. Then to top it all off, you had a massive demand, a massive surge in people who wanted to buy homes because one, they wanted to take advantage of low mortgage rates. And second, you had a lot of people sitting at home because of this pandemic saying, maybe it's time for an upgrade. If I'm going to spend this much time in my home, maybe I should upgrade my home because now people are working from home. So now people wanted to move out of the city and move into the suburb, and they wanted a home with an office. So you had a massive amount of people that wanted to upgrade their homes, get a home with an office, so now they can live this work from home lifestyle because that's the future of our economy for a lot of people. And so you had this wave of people that wanted to buy homes, and they want to buy a home right now because you want to take advantage of these low mortgage rates. But you had a very small inventory of homes available for sale. So now, if you're selling a home and you have 50 people that are fighting to buy your home, you're gonna say, all right, well, you guys fight each other. The best price wins. This perfect storm coming together caused home prices to grow faster than we've ever seen happen in history. But now we're starting to see a cool down. I mean, there's no possible way that you can see home prices or any asset price grow straight up like this forever. I mean, it's just unsustainable. Eventually, you're gonna hit a point where people can't afford homes. And that's what we've been starting to see. And now Fortune says that we could see something else start to flip the housing market. The article says that the Biden-Harris administration has made it clear that it has no plans for another extension of the mortgage forbearance program, which will lapse on September 30th. Then it goes on to say that in a nation of more than 80 million homeowners, 1.7 million might not sound like a lot until you consider the fact that there are just over 600,000 homes available for sale right now on Realtor.com. The fact is, this year, housing inventory hit a 40-year low. So even if a small percentage of these struggling 1.7 million borrowers opt to sell rather than returning to the monthly payments, it could cause a shock in the housing market. We're finally starting to see the supply of homes available for sale starting to grow. In June 2021, we saw the inventory of homes grow by 8.8%. In July of 2021, we saw it grow by 10.4%, and it looks like this inventory is going to keep growing. Couple the rising inventory of homes available for sale with the fact that it's becoming harder for people to afford a home, and now you have an interesting situation in the housing market, which we're about to talk about. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. By the way, if you want to see some more Minority Mindset, we have just launched a couple new YouTube channels. We launched the Minority Mindset Clips channel, where you can see some of the best highlights from our Minority Mindset channel. And we also launched the Minority Mindset Spanish channel, where you can watch our Minority Mindset videos in Spanish. So if you want to check out these channels and subscribe to them, I'll put the links to where you can check out these two YouTube channels in the description below. Now, the reason why mortgage rates are so important to understand is because small differences in mortgage rates can make a huge difference in the amount of money that you pay. So let's take a look at these two homes. Let's assume that these are two identical homes. Here is $625,000 and here is $500,000. The only difference is the interest rate that you're going to pay on your mortgage. Let's assume that for the sake of this example, here you can get a mortgage for 3%, and here you got to pay 5% a year on your mortgage. In this situation, buying the home for $625,000 with 20% down with a 3% mortgage rate, this is going to cost you $2,100 a month for your mortgage. Here, if you do the same thing, you put down 20%, but now you have to pay 5% a year in interest. Even though this home is significantly cheaper than this home, you're going to pay $2,100 $50 a month. You're paying more money here every single month than you are here just because of the small difference in mortgage rates. Now, obviously, your down payment's going to be a little bit different. If we're talking about a 20% down payment, that means here you're borrowing $500,000, and in this situation, you're borrowing $400,000. So the amount of equity that you needed to bring to closing, this is the cash that you had to pull out of your pocket, assuming that you did a 20% down payment. Here is $125,000, and here you had to bring $100,000 to closing. So you had to bring more money out of your pocket here to buy the property, but it's going to save you $50 a month over the course of your mortgage as opposed to here. And there's a pretty big difference in price. I mean, we're talking about a $125,000 difference in price, and the small mortgage rate difference still allows you to keep more money in your pocket every single month. We were seeing mortgage rates close to 5% prior to the pandemic, and now we're seeing mortgage rates close to 3%, sometimes less than 3%, sometimes a little bit more than 3%, depending on what type of mortgage you're getting. But this is kind of what we've been seeing, and this is why people have been flocking to buy a home, because they want to take advantage of these cheaper mortgage payments. And then they look at the price of homes and they say, all right, yeah, I'm going to have to pay a little bit more to buy a home, but at least now my mortgage payments are still cheaper than they would have been if I bought the home for a 10% lower price, because now I got this cheap money that I can borrow. Now, the situation that we're facing right now is really interesting, because on one hand, we have this mortgage forbearance program finally coming to an end, which means that we'll probably see a lot of people start to sell their homes more, because what we've seen happen over the last year is that as people leave the mortgage forbearance program, they're a lot more likely to sell their home, because now they have to start making the payments and they got to decide, do they want to upgrade or do they want to downgrade and no longer have to pay these huge mortgage payments for a home that they're really not using anymore. Plus, at the same time, the Federal Reserve Bank keeps talking about how they want to raise interest rates. It is unsustainable to keep interest rates as low as they are right now. It is causing a lot more inflation, and so the Federal Reserve Bank keeps talking about how they want to raise interest rates, and so we know that interest rates will go up unless something crazy happens between now and 2023. But assuming that our economy continues to grow, then the Federal Reserve Bank will raise interest rates. And the third concern that we're facing right now is the affordability crisis in the housing market, because it's becoming a lot more expensive for people to go out and buy a home. I mean, we're seeing home prices grow very quickly, which means if you don't have cash in your pocket, you might not be able to afford a down payment on a home, because home prices keep going up and up and up. And so it's become harder, especially for people that are looking for more affordable homes, to go out and buy a home, because you have this low inventory of homes available for sale, and these affordable homes are no longer affordable. So a lot of people who want to buy a home can no longer afford to buy a home, and if mortgage rates go up more, well, then that can make it even more expensive to buy these homes. This is why the Fortune article says that we can experience a shock in the housing market, because if you have a lot of these people who are homeowners who no longer want to own their home, maybe they want to downsize, or maybe they don't want to have these monthly payments anymore, who now want to sell their home and take advantage of these super high home prices, and then you have this huge wave of people starting to sell their homes, but you don't see the same demand from people wanting to buy homes because homes are so expensive now. Well, then this could cause a real shock in the housing market, because people are trying to sell their homes, but no one's buying these homes. If that happens, now sellers are going to say, oh, maybe I listed my home a little bit too high. Maybe I should cut the price by $10,000. And this is how you can start to see housing prices start to correct and come back down to earth. This doesn't mean that we're in for a realistic crash. It means we're going to see a lot more inventory, and it's going to be interesting to see what happens on the demand side. Because if we still have a lot of demand from people wanting to buy homes, maybe they couldn't qualify before, or maybe they couldn't buy a home or afford a home before, and now they can, well, then we would be okay. But if we don't see the same demand, then this could cause home prices to come down a little bit. It's impossible to predict what's going to happen, which is why if you are in the market for a new home right now, you just got to make sure you're smart. Make sure you can buy a home that you can afford. Don't over leverage yourself. Don't overstretch yourself. And if you're refinancing your mortgage because now you want to take advantage of these lower interest rates, well, again, be smart when you refinance your mortgage. There's nothing wrong with owning a home. I think it's great when people are homeowners. The problem is you have a lot of industries that profit by selling you the idea that your home that you live in is an investment. And what this does is it incentivizes people to now buy bigger. And instead of you owning a home, your home ends up owning you, because your home ends up being a money pit. Now, not only are you the one working to pay off your mortgage, but you're the one that's working to upgrade your kitchen, you're upgrading the bedrooms, you're trying to finish the basement, and then when the roof breaks, you have to take care of that, and when the furnace goes out, you got to put in a new furnace, and you're constantly paying for upgrades on this big property that you couldn't afford in the first place. So if you want to own a home, great. Just make sure you can afford it first. It's impossible to try to time the market. Instead, what you want to do is you want to understand that a home is a place that you're going to build memories. And what you want to do is you want to afford this memory building place that you have. That means you need to make sure that you can afford the down payment, that you can afford the monthly payments, and you can afford whatever upgrades, furniture, and maintenance that you need to maintain the home. Now, I want to go over the risks and my concerns with the housing market in just a second, but if you are looking to buy a home, or if you're looking to refinance your mortgage right now, just be smart. Make sure you shop around a little bit, because some lenders are going to charge you a whole lot more than other lenders on the exact same home. So you want to do your due diligence on the mortgage. Make sure you're shopping around. Make sure you're getting the best rate possible, because you don't want to overpay for your mortgage. And this doesn't mean that you need to go around and start calling around different banks and start calling a whole bunch of different lenders, because thanks to the internet, you can just use a mortgage comparison tool, because that will help you determine which lenders are charging what. That way you can save a whole lot of time for yourself. And the following is an advertisement from our sponsor Credible, who operates the mortgage comparison website. At Credible, you can check pre-qualified mortgage and refinance rates at no charge to you. They have multiple lenders competing on their marketplace, so you can compare great rates and pick the option that's best for you. The process is simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes, and then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Credible's pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do that with Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I got the link to how you can do that with our sponsor Credible in the description below. I was at the bank the other day, and I like to ask people that are in the financial industry what's going on, because they know a lot more than what you just see in news articles and headlines, because news articles and headlines are usually kind of slow to report what's actually going on. So anytime I talk to somebody who's working in the banking industry or the real estate industry or the credit industry, I want to talk to them to see what's going on. So every time I would talk to a banker, I would ask him the same question. How's the housing market doing? Are people still buying homes like crazy? It's an easy way to get a gauge on how the market is doing, just based off of how people react. And a few months ago, every time I asked this question, every single banker would say, oh my God, the market is so hot. We are lending money left and right, and we can't keep up with all these mortgage requests. Now when I ask that question, I get a little bit of a different response. Everyone says now that yeah, people are still buying homes like crazy, but it's not as hot as it was. The market has definitely cooled down, but there's a couple more things that these bankers have told me that is really starting to gauge my interest. The first thing has to do with cash out refinancing. When mortgage rates go down, one of the best things that you can do is refinance on your mortgage, because now you can pay a whole lot less money on your mortgage just by getting a lower interest rate on your mortgage. But the issue with mortgage refinancing is a lot of people use it as an opportunity to pull out equity on their homes to now have this cash in their pocket to go out and buy other liabilities with. What I've been hearing more recently is that people have been doing a lot of cash out refinancing. And so over the last year, we saw property values skyrocket. So if you had a $400,000 home, maybe now your home is worth $500,000. What that means is you have a whole lot of brand new unrealized equity. That's kind of like invisible money in your home, because you might have bought your home for $400,000 a few years ago, and now people are buying similar homes for $500,000. And so you, if you sold the home, you might be able to walk away with $500,000, but you don't want to sell your home. You want to keep living in your home. So instead of selling your home, what you can do is you can go to the bank and tell the bank, hey, I have a $500,000 home and I only owe $350,000 on it. Can I pull out some more cash on my property? So now the bank's going to look at you and they're going to say, sure, we'll give you $450,000 as a refinance. So now you take this $450,000, you put it in your pocket, you use $350,000 to pay off your old mortgage, and now you suddenly got a whole new $100,000 in your pocket, and this is tax-free. So now you take this $100,000, maybe you invest a little bit, hopefully, or then you now take this cash and you go out and you renovate your home. You build a new kitchen, or you go out and you buy a new car, or you go out and you go shopping, or you go on a vacation, or you go out and buy a new boat. So the diagram, what's going on? Let's assume that you bought this home a few years ago for $400,000, and today you owe $350,000, so I'm gonna put O here, $350,000 to the bank on your mortgage, and at the same time, the value, I'll call this the FMV, the fair market value of your property, is $500,000. So you have kind of this invisible equity in your property because now you think that you can sell your home for $500,000. So now you go to the bank and the bank says, all right, you know what? We will give you $450,000, 450, and now you take this $450,000 and you're gonna pay off this old bank, and you have $100,000 that now you have in your pocket at a super low mortgage rate, and now you owe $450,000, but hey, your home is worth $500,000, so what's the big deal? If you now take this $100,000 and you go out to buy a rental property, or you're going out to invest it, or using it to start a business, that's good. Now you're investing this money, and hopefully you can grow this money way faster than the 3% a year that you're going to pay on this refinance. But the reality is a lot of people are not doing that. A lot of people are now pulling out all this cash from the properties. They're taking this extra cash, and then they're going out and they're buying liabilities. So they're buying things that lose their money. They're going out and they're upgrading their wardrobes. They're buying brand new cars. They're buying fancy vacations, and they're buying boats using this cash from their property. Then, because interest rates are so low, you also have people pulling out a second line of credit called a HELOC, a home equity line of credit, from their property. So now they open up a second loan, pulling out more cash from the property because mortgage rates are so low, interest rates are so low. If I pull out this new equity line of credit, it's better than me having credit card debt. And so now people have this brand new cash, and they're using this cash to now go out and spend. They're going shopping with this brand new money, which is good for the economy, is good for businesses because now you're spending. It's good for banks because now you have more loans that you're going to be paying back for the rest of your life. But it keeps the majority of people in debt. And the concern here is what happens if property values start to correct and then people go underwater on their properties because now people have been pulling out all this brand new equity in their properties when we've been seeing home prices skyrocket at some of the fastest rates that we've ever seen in history. The hopes that every bank has is, hey, we have a little bit of buffer here. The home is worth $500,000 and we're only letting them refinance $450,000 or maybe $400,000 depending on the bank and depending on the loan. So banks hope that this cushion, this buffer, will be enough so people don't have to be underwater on their homes. The issue is what happens if more and more people start to sell their homes, or people don't have the ability to now pay back all this money. Debt is never a problem until it becomes a problem. If somebody has $30,000 worth of credit card debt, it's not a problem as long as they can make the monthly payments, but it becomes a problem if you no longer have the income to support your debt payments. And so as long as people are making money and they're making enough money to afford the cost of living and they're making enough money to pay back their mortgages, it's not a big deal. But if the economy slows down and people don't have the ability to pay their mortgages, they don't have the ability to pay for this extra HELOC, home equity line of credit, now it becomes a problem. Because this might force people to sell their home because they are sitting on a property that right now is positive. They're sitting on a property where they have equity in there, but they just can't make the payments because the cost of life is so expensive. I mean, we've been seeing inflation happen all around us. The price of everything keeps going up. And if it gets to the point where people are saying, you know, let me just sell my property and downsize a little bit because life is so expensive, and you start to see more homes hit the market, then this could push home prices down a little bit. It could cause a little bit of a home price correction. And if that happens, and you have a lot of people with no equity in their properties at all, because either they bought the property with little to no money down, or they're pulling out all the cash from their properties, well, then this could cause an issue in the housing market where you have more people that are underwater on their properties, and this could cause a new wave of foreclosures in the future. The second thing that really concerned me is when I would talk to these bankers, I would always ask them, so people are locking in 30-year fixed rate mortgages, and up until maybe a month and a half ago, pretty much everybody said, yeah, people are locking in these 30-year fixed rate mortgages at 2.8% a year or at 3.1% a year. Now, you're starting to hear something different. You're starting to hear that more and more people are not locking in fixed rate mortgages. They're going towards the variable interest rate mortgages because these variable interest rate mortgages offer you a very low introductory rate for the first few years. Sound familiar? If you go borrow money at a 30-year fixed rate mortgage, it might cost you around 3% a year. But if you go get a variable interest rate mortgage, you can lock in a 2% interest rate, maybe even a 1.9% interest rate for the first 5 years. And then the variable interest rate will adjust, and then your mortgage payments will adjust based on what interest rates are. Now, I'm not gonna lie, I was a little surprised. I was kind of caught off guard when I heard that because I thought that people learned their lesson after the 2008 crash and people were buying these homes that were too expensive with variable interest rate mortgages, because when you bought a home that you couldn't afford with the variable interest rate mortgage, it suddenly became affordable for the first few years because now you have a super low mortgage rate. But then if mortgage rates adjust and then mortgage rates go up, well, now your mortgage payments are going to go up. And this is kind of the situation that we're seeing right now. In 5 years, chances are mortgage rates are going to be significantly higher than what they are now. Now, if you're planning on paying off your entire home in the first 5 years, that's not a big deal. But if you're like most people and you don't plan on paying off your mortgage over the first 5 years, you want to pay it off over 25 or 30 years, then this can be a little bit concerning. Because in 5 years, chances are mortgage rates are going to be higher. So when your variable interest rate adjusts, chances are your payments are going to be a whole lot higher then than what they are now. So I asked the bank manager, what happens if in a few years these variable interest rates adjust and people can no longer afford these higher payments? And what he said was also very interesting. He says by the time that happens, hopefully home prices will be a little bit higher so people can just refinance into a fixed rate mortgage in a few years. That way now, yeah, they have a little bit of a higher mortgage, but they don't have to make these high payments for the first few years. That is one of the worst and scariest things you can do when it comes to taking care of your finances and your family's finances, because now the health of your financials are dependent on the economy and the housing market, which you have no control over. If people start selling their homes, if people can no longer afford their homes and mortgage rates go up, now you could potentially be underwater on a property that you can no longer refinance on. And this is exactly what we saw happen before the 2008 crash. People were going out and buying homes they couldn't afford with the help of these variable interest rate mortgages. And then when the interest rate changed and interest rates went up, people couldn't afford these new monthly payments, so they tried to sell, but they couldn't sell because now they were underwater on their mortgages, and this caused a whole new wave of foreclosures. The difference between now and the 2008 crash is we're not seeing the type of subprime lending that we saw before the 2008 crash. We're not seeing the ninja loans that we saw happen prior to the 2008 crash. We have a whole lot more qualifications, and it's a whole lot more difficult for somebody to go out and borrow money than it was back before the 2008 crash. But we're starting to see people follow the same habits that we saw more than a decade ago, because people want to go out and buy a home. They want to be a homeowner, and they're doing whatever it takes to do that, even if that means they're going to go out and get a variable interest rate mortgage where it's almost guaranteed that your mortgage payments are going to be a whole lot higher in a few years than they will if you just locked in your mortgage payment today. Now again, this goes back to the game of tug of war. If we start to see more people start to sell their homes, no banker and no government official wants to see the housing market slow down, because the real estate market is such a big piece of our economy. So what could you potentially see happen? You could potentially see banks start to loosen the lending restrictions to make it easier for people to achieve the American dream of owning a home. And if people no longer have the same requirements to go out and buy a home, well then they might be able to go out and buy a home, buy a big mansion, the American dream, thanks to the help of banks, Wall Street, and the government. It's greed on the part of the homeowner, because the homeowner wants to buy a home even if they can't afford to own a home. It's greed on the part of the bankers, because bankers want to keep lending money because that's how they make money. And it's greed on the part of the government, because the government doesn't want to see the economy slow down, especially before another election. This is something where we're not going to know the effect of what's going on for at least a few years, but this is why it's so important for you to be aware of what's going on. That way you can be smart with your money. That way you can take care of yourself, your finances, your family, and your community, and not rely on somebody else to take care of you, because a lot of times these other people don't have your interest in mind. If you enjoyed what you saw so far, then you're gonna love this. Buying a home is exciting and it's a big deal, but the process isn't always straightforward. You gotta deal with real estate agents, bankers, title companies, property inspectors, and because homes are so expensive, if you don't know what you're doing, you could end up way overpaying. I've seen real estate from a lot of different angles, because I used to be a real estate agent, I'm a real estate investor, and I'm an attorney. Now, I'm not gonna go over the steps on how to actually buy a home in this video. I already made a video on YouTube where I went over how to do that exactly. If you wanna watch that video, I will link it for you in the description below. But in this video, I wanna go over the things you need to understand about getting a mortgage. If you wanna buy a $400,000 home, chances are you don't got 400 grand just sitting at the bank that you can use to buy the home. So you're gonna work at the bank to get a mortgage, that way you can actually buy the home, but you wanna make sure you're not getting taken advantage of by your bank. There's 5 things you wanna make sure you understand when you're getting a mortgage, and I'm gonna go over all 5 of these things in this video, so make sure you watch this video until the end. Before you go out and actually start looking at homes and making an offer, the first thing you want to do is get pre-qualified and get prepared to actually getting a mortgage. All getting pre-qualified means is that you've worked with a lender or a banker to get the basic credit process done. That way the bank or lender can see if they're willing to give you a loan. If you're not pre-qualified, you don't look like a serious buyer. Because I can tell you from personal experience, it is a major headache working with somebody who's not pre-qualified, because if you fall in love with a home and you put an offer and it gets accepted, and now you have to kind of get pre-qualified and get approved to get a mortgage, and you can't do that, it is a major hassle because now you're wasting your time, you're wasting your real estate agent's time, and you're wasting the seller's time. I was selling an apartment complex that I was a part owner of, and a lady brought an offer to me. The problem was she was not pre-qualified, but she gave me a pretty good offer. Now, the real estate agent I was working with kept saying, oh, don't worry, Jaspreet, she has a lot of money, she's really successful, she'll have no problem getting a loan. So I thought, okay, fine, I'll let this one go. So now we're in contract. I take my property off market, and a month goes by, she couldn't get approved for a loan. 2 months go by, she couldn't get approved for a loan. 4 months go by and she could not get approved for a loan. At this point, we had to cancel the deal, and I had taken the property off market for 4 months, and it was just a huge waste of time on my part, on my real estate agent's part, and her part. As soon as you get pre-qualified, you automatically have an edge over other buyers who are not pre-qualified, because if I'm selling a home and I get 2 offers, one is from somebody who's pre-qualified and one is from somebody who's not pre-qualified, and you're pre-qualified and your offer is slightly lower than this person's, I'm still gonna take your offer even though it's less money, because it's less headache and less uncertainty because you've already gotten pre-qualified. Part of the pre-qualification process is you getting prepared to actually get a mortgage, because, well, getting a mortgage is kind of a difficult process. You're essentially kind of selling yourself to the bank, and you want to show the bank why you're a good investment for their money, because if you can show the bank that you're a good investment, they will reward you with a lower interest rate. First, you got to show the bank your proof of income. So you might need to show your tax returns, your W-2s, your 1099s, whatever income that you have, at least for 2 years steadily. You need to show this to the bank. That way the bank can see that you're making money consistently. Second, you want to show the bank any assets you might have. So maybe you own some real estate investments or stock market investments or other assets. You want to show this to the bank so you can show the bank what you have. Third, the bank is going to want to know what debt you have and how much debt you have. Your debt to income ratio is literally just a fraction, where banks look at how much debt you're making and they divide it by your income. So nowadays, banks typically like to see a debt to income ratio of less than 36%. So they want to see that your debt is less than 36% of your income, and out of this 36%, they typically don't want to see more than 28% for your mortgage. So this is how much your mortgage should be max, and the rest of it can be your credit card debt, your car loans, or whatever. This is how much banks ideally want to see, but sometimes you'll see banks stretch this total debt to income ratio from 36% up to 43%. So if you have a lot of outstanding debt, credit card debt, car loans, it's going to be harder for you to qualify for a mortgage. So you need to work right now to pay down that debt. That way you can lower your debt to income ratio. The fifth thing your bank or lender is going to look at is your credit score. You can get approved for a mortgage with a credit score of 620 or higher, but if you have a 620 credit score, you're going to have to pay a lot more fees and a lot higher interest rate, because the bank's going to look at you like a riskier investment. If you want to get the best interest rates and not pay these extra fees, you want to have a credit score of at least 760 or above. If you're looking for ways to boost your credit score, you can use a credit card strategically, and you can work to pay your bills on time. If you want to learn more about how to actually boost your credit score, I'm not going to go over that in this video, but our team wrote an article on how to do that on our website, theminoritymindset.com, and I'll link it for you in the description below. The second thing you need to understand about mortgages are the different kinds of mortgages out there, because not all mortgages are created the same. First, let's talk about the differences between a fixed rate mortgage and an adjustable rate mortgage, an ARM. So fixed rate mortgages are very straightforward. If you go to the bank and tell them you want a loan, they might say, all right, this mortgage is going to cost you 2.8% a year, and if you agree to that for the next 30 years, you're going to be paying 2.8% a year in interest on your mortgage, and that's it. It's not going to change whether interest rates go up or down. This is the interest rate you are going to pay, and you have a set monthly payment. With an adjustable rate mortgage, it's not like that. With an ARM, the amount of money you're going to pay on your mortgage is going to change depending on what interest rates are. So one type of ARM that became very popular during the 2008 crash was the 228 ARM. What that means is during the first 2 years of your mortgage, you're going to have a very low introductory teaser interest rate. So during the first 2 years, your monthly mortgage payments are very low. Then after that, your interest rate is going to change every 2 years depending on what interest rates are. So if interest rates go up, then your mortgage payments are going to go up, and that's going to change every 2 years for the next 30 30 years. So you don't know what your mortgage payment is going to look like in 5 years or 10 years because you don't know what interest rates are going to be. If interest rates go up, your mortgage payments can go up. Another example of this is the 5-to-1 arm. What this means is during the first 5 years of your mortgage, your interest rate is fixed, and then every year, every 1 year after that, your mortgage rate is going to change depending on what interest rates are. And then the 5-by-5 arm says that during the first 5 years of your mortgage, your interest rate is not going to change, but then every 5 years after that, your interest rate is going to change depending on what interest rates are. Arms can be good when you're in an interest rate environment where you think interest rates are going to go down. But right now, we are in one of the lowest interest rate periods in history. It doesn't make sense to get an arm when interest rates are already lower than they've ever been. In the future, the only way interest rates can go are up unless we go negative interest rates. But even then, we're already seeing the lowest interest rates in history, and we saw what happens if you tie yourself into an arm and then interest rates go up, because that's exactly what happened in the 2008 crash. Everybody was getting into these 228 arms thinking that they were getting this amazing low teaser rate for the first couple years, and then real estate prices came down and people couldn't refinance, and now everybody's mortgage payments were way higher than they anticipated, so people started foreclosing left and right. So arms can be good hypothetically when you're in an interest rate environment where interest rates are going down, but they come with their own fair share of risk. You can mitigate that risk just by getting a low fixed rate mortgage, and now you know exactly what your mortgage payments are going to be for the entire length of your mortgage. You have two main categories of mortgages. You have conventional mortgages, and then you have government mortgages. Government mortgages is money coming from the government, and conventional mortgages are not. That's the main difference. But the way these different types of mortgages play out is a little bit different when it comes to your down payment and how high your interest rate is going to be, so you really want to understand the differences. So starting with the conventional mortgage, you have a couple different kinds. You have conforming mortgages, and then you have non-conforming mortgages. All the difference is how big your mortgage is. Fannie Mae and Freddie Mac set what the limit is for a conforming mortgage, and if you get a mortgage that's bigger than that, it's called a non-conforming mortgage, and then you need something called a jumbo loan. So the difference between these two types of mortgages is really just how big your mortgage is. In 2021, the limit for a conforming mortgage is right around $550,000 for your mortgage, unless you're in a really big city like New York, where now your mortgage limit is a little bit higher. But if you get a mortgage that's smaller than that, you will get a conforming mortgage. If you need a mortgage that's bigger than that, then you're going to need a non-conforming jumbo loan. If you qualify for a conventional conforming mortgage, then you can get a home with a down payment as small as 3%. Now, if you put down 3%, you're going to have to pay additional fees like PMI, which is private mortgage insurance, where you're essentially buying insurance for the bank just in case you foreclose. But just understand that you can buy a home with a low down payment. However, it's going to cost you a little bit more in fees. With a non-conforming mortgage, so if you're getting a larger loan, a jumbo loan, then you're not going to typically get a down payment that's as small as 3%. You're going to have to pay a larger down payment because the bank is risking more money on you. So they're going to want you to put more skin in the game. Once you have 20% equity in your home, or if you put down 20% equity when you buy the home, then you can wipe out PMI. So until you have 20% equity in your home, you're going to be paying that additional fee called PMI with a conventional mortgage. And the advantage with a conventional mortgage over government-based mortgages is typically you get a lower interest rate here because you have a higher credit score requirement. So it's a little bit more difficult to qualify for a conventional mortgage than it is for a government mortgage. Now, moving on to government mortgages, the first type of mortgage is the FHA mortgage. So FHA is the Federal Housing Association, and the whole point of these FHA mortgages is to help people qualify for a home and mortgage who don't have the best credit score and who might not be able to put down a lot of money as a down payment. So to qualify for an FHA mortgage, you need to only have 3.5% as a down payment, and you can qualify for an FHA mortgage in some instances with a credit score lower than 620. Now, the downfall with this is FHA mortgages come with higher interest rates and higher fees. So because lenders will kind of look at you more as a risky investment, you're going to have to pay the price. And so one thing you're going to have to do is you're going to have to pay an upfront insurance fee when you get an FHA mortgage. And then you're going to have to pay an insurance fee on the back end for the life of your mortgage. So it's not PMI like you have to pay here. It's a different type of insurance, but you have to pay this additional fee in addition to your regular mortgage payments just because you're getting an FHA mortgage. The difference between the insurance fee that you have to pay with an FHA mortgage every single month and this PMI that you have to pay here if you don't have 20% in equity in your home is once you have 20% equity in your home with an FHA mortgage, you have to keep paying that fee. So this fee doesn't go away once you have 20% equity versus PMI goes away here once you have 20% equity. So the whole idea is these government mortgages can help you get a home, and then once you can qualify for a conventional mortgage, you can refinance out here and get one of these. That way you can pay a lower interest rate and pay less in fees. Second is the USDA, United States Department of Agriculture loans. These are more for rural homes. This is for people who are lower income or moderate income. This allows you to buy a home with 0% down payment in certain instances. So you can buy a home with nothing down, but again, you got to pay higher fees. You're going to have to pay another insurance fee with your mortgage here, and that does not go away once you have 20% equity. So once you have 20% equity, it might make sense for you to refinance and get another loan here depending on what interest rates are. And third are your VA loans. This is for military personnel and people who were in the military. So VA loans let you qualify for mortgages with 0% down, and these can be typically lower interest rate mortgages. However, because you're getting a lower interest rate and because you're putting 0% down, you have to pay a higher upfront fee here, an insurance fee with the VA mortgage, than you see here or here. So to qualify for a VA mortgage, you have to be a part of the military or have been a part of the military, and then you have to pay that additional fee in the beginning. But with the VA loan, unlike FHA and USDA, you don't have the ongoing insurance fee. So these government mortgages can help you qualify for a home, but with an FHA and USDA mortgage, you might have to pay higher fees during the life of your mortgage. So it might make sense for you to then refinance into a conventional mortgage, again, depending on what interest rates are when you're looking at refinancing, because then you can save some money on your interest rate mortgage and you might not have to pay some of these insurance fees. Third, you got to understand what changes your mortgage rates. There are 5 big factors that affect your interest rates, and we've gone over 4 of them. So one of them is whether you're getting a fixed rate or an adjustable rate mortgage. Second is what interest rates are. These are set by the Federal Reserve Bank. Third is how much your credit score is. Fourth is how much money you're putting down. And fifth is how long your mortgage is. To understand this, you really got to look at it from the perspective of the bank. So banks have all this money, and when they loan this money out, it is an investment for the bank. So the riskier the investment is for the bank, the more money they're going to want to see as a return. So if you're asking for a risky loan, the bank is going to want to charge you more money. And one of the ways to qualify a riskier investment is how long you want to borrow the money for. The longer the bank has to go without their money, the riskier the investment is. And so when you compare a 15-year mortgage with a 30-year mortgage, a 30-year mortgage is going to seem a little bit riskier for the bank because their money is going to be with you for 30 years. And so the bank is going to charge you a little bit higher in interest. With a 15-year mortgage, the bank is going to get their money back in 15 years, not 30 years. And so they can charge you a little bit less in interest because it's less risky for the bank. This is where you have to make more of a personal financial decision, because when you get a 30-year mortgage, you can buy a bigger home and have a smaller monthly payment because your payments are extended over 30 years instead of just over 15 years. So if you look at the same mortgage over 30 years or 15 years, your 15-year mortgage is going to have a lower interest rate, but your monthly payments are going to be higher because you have to pay the mortgage off within 15 years. If you extend it over 30 years, your monthly payment is naturally going to be smaller, so you can qualify for more home. One thing that you can also do to help you with your mortgage rate is just shop around. It's crazy how many people don't do this. They just go to the bank that they normally go to for their mortgage without shopping around. Some lenders are going to charge you a whole lot less in interest for the exact same mortgage. So it is in your best interest to shop around and make sure you're getting the lowest interest rate on your mortgage. There's really no excuse not to shop around anymore, because you can shop around on the internet for your mortgage and it only takes a few minutes. If you want to learn more about how to do that, our team put together an amazing guide that walks you through how to get the best interest rate on your mortgage or refinance. So if you want to learn more about how to do that, I will link the article for you in the description below. Fourth, when it comes to getting a mortgage, it is your job to know what you can afford. It is not your real estate agent's job, and it is not your bank's job. Your real estate agent's job is in the business of selling you a home. Your banker's job is in the business of selling you a mortgage. It is in both of these parties' best interest to give you the best home, which is typically the biggest home, which is also the home that's going to give these two parties the biggest commission check. Now, your job is to know what you can afford for your wallet. Just because you can qualify for $1 million home doesn't mean that you can afford it, and it doesn't mean that you should buy it. It's funny, every time I say this, I get these kind of angry messages from bankers or real estate people because I'm telling you to buy what you can afford, not buy what you can can qualify for. And so that's not good news for the real estate agent or the banker. But let me show you what I mean. When it comes to affording a home, there's two things you have to look at. You have to look at the down payment and then the monthly payment. Your real estate agent and your banker's job is to get you into the home. So they're going to do whatever they can and pull whatever strings they can to get you into a home, even if you can't necessarily afford it. So when it comes to the down payment, a lot of times they're going to try to push you into a home with 0 to 5% down. That way you can get into that home of your dreams. Now, just because you can get into a home with 0% down or 5% down does not mean that you can afford it. If you really want to be able to afford your home, you want to be putting down 20%. Now, I know that's a lot of money. You want to buy a $300,000 home, that's $60,000 in cash you got to put down. But if you really want to be able to afford a home, you need to be putting down 20%. When you put down 20%, now you don't have to pay the higher fees, you don't have to pay the higher interest rates, and you have more equity in your home. When it comes to your mortgage payment, your monthly payment, your bank is going to say that they want your monthly payment to be something like 28% of your gross take-home pay. So this is before taxes. So if you take your total take-home pay before taxes, 28% of that should be your mortgage. I don't want you to pay that much money towards your mortgage, because then on top of that, you got to pay your taxes, you got to pay all of your other bills, your utility bills, your car payments, everything else. I don't want you to do that. So what I want you to do is I want your monthly payment to be 25% of your actual take-home pay. So you take the money you're making, you pay your taxes, and now out of what's left, 1/4 should be the maximum of how much you're paying towards your mortgage. When you do that, you will leave enough money for your savings and for your investments. That way you can work to build yourself wealth instead of having all of your money going into the bank to make the bank rich. I want you to use your money to make yourself rich by paying a maximum of 25% of your take-home pay to your bank, and then using as much as you can to invest and save in your own wealth. Now, I know this might mean you might have to work a little bit harder to own a home, you might have to buy a little bit smaller home, and you might have to save more money for your down payment. But you are going to sleep a whole lot easier knowing you're not stretching yourself too thin to buy this dream home that you can't even afford. Now, you're using your money the right way. That way you can make yourself rich instead of just your banker richer. The fifth thing that you have to understand when it comes to getting a mortgage is you might potentially want to refinance out of your mortgage in the future. So I mentioned this a little bit earlier in this video. If you get a government mortgage, you might have to pay a little bit higher interest rates, and you might have to pay additional insurance on your mortgage. Now, if interest rates come down and you build more equity in your home, you could use this as an opportunity to refinance into a lower interest rate mortgage and to get rid of some of these fees. That way now you have the home that you're still living in, and all you see happen is your monthly payments drop because you have a better mortgage now. The thing that I want to remind you here, that in order to refinance your mortgage, you need to see property values stay the same or go up. But real estate prices don't always go up. So you want to keep that in mind, because people who were buying homes in the early 2000s, they were buying homes with these low teaser rates, thinking that when interest rates go up, they'll just be able to refinance their mortgage and then get these lower interest rates. The problem was that home prices dropped. So when people went to refinance their mortgages, turns out they couldn't qualify for a new refinance because they didn't have any equity in the homes because their home values dropped. So yeah, refinancing can be a great tool if you can refinance into a lower interest rate mortgage. But you don't want to go into a home thinking, yeah, you know what, I'll make the sacrifice now. That way in 5 years I can refinance into a better mortgage. You don't want to do that because there's no way to predict what the world or what the real estate market or what the housing market is going to look like in 5 years. You don't want to be in that position that people were in back in 2008 and 2009. If you do want to see how to refinance your mortgage and save the most money, the article I linked in the description below walks you through how to do that. But what I'm trying to say is this is why it's so important for you to be able to afford the home that you're buying right now, because you don't want to run in a situation where 5-10 years down the road, home prices drop, or you can't refinance because you thought you were going to be able to, and now you're stuck in a home that you cannot afford. Make sure you can afford the home today and not kind of rely on the stars to align in the future so you can afford the home. Thank you for watching. If you enjoyed this video, here's a video on things you need to consider before you go out and buy a home. And while you're at it, download our free guide on how to start generating passive income. And as always, keep hustling. The three main factors that a lender is going to look at when it comes to getting you pre-qualified and getting you a mortgage are your credit score, your income, and your debt. If you just want to get a mortgage, the minimum credit score that you need is something like 620.